All right. Good morning, everybody. So we got some European central bankers and Fed speakers, and then we're going to be getting some spot data, kind of like a early data. It's not really referred to that way, but if you read what its description is, you kind of get the idea that it's just early numbers. Trying to gauge today's economic impact. FX Street is really good for that. It's free. You can sign up and get yourself, like a free account, but I really don't recommend it. These guys will bomb your email nonstop with just a bunch of junk. And the fact that you can access everything without having to sign in and without having to have an account, there's really no reason to get one. It remembers my settings, even though I'm not logged in, and that's really all I need. But this is a great place to identify what the anticipated impact is for different economic events, right? We can't always gauge on our own, especially as a newer trader, if the economic event on the docket for the day is something that usually moves markets, sometimes moves markets, or rarely ever moves markets. And that's where this gauge comes in, from a light yellow to kind of a burnt orange, and then a dark filled in solid red box. As you can see tonight, around the world, we've got large economic impact. Now, I know this is the morning briefing and we talk about day trading a lot, but if I'm in a swing account, especially in a small account, and I'm trying to decide if I should take profits where I'm at, it's always that debate. You coming into resistance, your trade's doing okay, not a home run, and you're just kind of considering, should I take some gains here, maybe reduce some of the position or close the whole position. And then you see something like this, and it's telling you that around the world tonight there's going to be a likely impact from an economic event. Good, bad, could go either way. You don't know. I don't know. And you could decide maybe to take some off because you're getting a little bit of a heads up warning, right? We focus a lot on what's happening in our own nation, and it's what's open while we're trading, but we do need to consider nations from around the world and how they're going to impact our markets. This one, to be fair, I don't think it's got a lot of weight to it. If it was Japan, that'd be a different story. But yeah, use what you got. We do have additional auctions today. Popular ones in the front end. The 2-year is an important one. So today, 1 o'clock, really, really want to watch the clock. Two of the best indicators that you can get is price action and the clock. They say price is king, and seeing what time it is can really save you. I'm going to try to circle back when we're done. We're going to hit on pivot points a little bit. I've been getting some questions on pivot points, and there's just so many of them, right? There's so many different styles and different ones out there. And I think how you approach a pivot point can really change how well you're doing with a pivot point. All right, so as you can see here, we have the 4-week at 11, and we have the 2-year at 1 o'clock. We're also going to hear about money supply. It's a really big deal right now. So, this afternoon, kind of be looking for a little bit of a rug pull or the market to get data that it doesn't like. And everything right now is on this hurry up, hold and wait on the debt ceiling and all of this. I'm still holding to my base case argument that they're not going to get it done, but that they're going to all agree on an extension, kick the can down the road 6 to 8 weeks, and in that window of time, they'll get something done. So everything that we have going on with the market, this whole hurry up and waiting pattern that we're in, is either going to run out of time because we're going to get some other economic event on the table, or they're just going to get tired of waiting straight up, which we haven't seen yet. But I'm going to keep that word yet in there. We haven't seen it yet, but the market's not going to tolerate this wait and see forever. And then there's, of course, the buy the rumor and then sell the news kind of aspect. And we haven't seen any of it yet, right? We've been range bound. So it's not yet a buy the rumor thing. I think after they announce that they're going to kick the can a few weeks down the road, we're going to see the market respond to that. And then when they actually do resolve this debt ceiling issue, we're going to see the market respond to that. We can see yet again this morning that the volume's a little light. 85 isn't bad considering we had 63 yesterday. None of these are really bad in the bigger picture. It's just more of a warning of what we would normally see versus what we're getting now. Normally we'd get, somewhere around 100,000 or more. If the market's waiting on an economic event, if we had, say, job numbers at 8:30, something like that, seeing it down in the 60s or the 50s would make perfect sense. And while we have economic agendas on the table today, they're not big enough to warrant this low of a volume. So we know that this low volume isn't because of an economic event. The market's waiting on something else. We just talked about what the something else is. But if you didn't know, which is kind of the whole point, if you came in and you just see the indicator and it's sitting at 65 or 85 and you haven't checked the news yet, you don't know what's going on, at the very least, you know that the market's waiting on something and you're going to want to go find what it is. Because you want to know when the likely wait is going to end, right? So you can sit out and wait for it to end, or take advantage of the lower volatility and play while you have the opportunity to use a smaller stop and not deal with so much violence. It's kind of a two-way street. Yeah, it is a custom indicator, but only because I have it print that white line for me. Otherwise, it's just I'm using the same indicator that Thinkorswim offers. It's called cumulative overnight volume. If you just search for the word night, NIGHT, it should pop up. It won't have my label with the line there, but you don't need it anyways. It doesn't affect how the thing works. Yep. All right, so once we see that, we really don't need it anymore. Kind of give back some real estate. And we are inside day. That's going to be the number one thing that we have to address. And unless we get some news, I don't think we're really going to get too far. Right now, that doesn't mean that we can't wick lower or that we can't wick higher. The strat and the megaphone right now is the default likely outcome until we get some news, right? So we're very likely going to expand, and that would mean that we go just a little farther and a little farther until finally something breaks. Right now, we've already had an inside day breakout to the upside, as minor as it was, and it didn't last very long. Then we've got all of yesterday's levels: open, high, low, close, and 50%. Right? You can break that down into Globex high and low, RTH high and low, the Globex open of the previous day, the RTH open, the close at 4, the close at 4:15, the close at 5. As you can imagine, there's a lot of pivots, right? And after a while, if you were to mark all of those out, you just have lines everywhere, especially when you've got days running together back to back like that. So inside day breakout failed. We're below the 50%, which puts us in a bearish bias. And We're focusing on 519 right now because the low of 519 comes before the low of yesterday, 522. Right, so Friday's low. Friday's close. It's not just Friday's close, it's the close for the week. So if we were marking, weekly open, high, low, close, we'd have 41.98, which, by the way, is one of your major pivot points. 4,200, 41.50 cog lines, and 41.98. So that's certainly one you want to keep track of anyways. And since we're already out on the higher time frame, may as well grab a couple more levels. 41.73 would be 50% of last week's price action. Which lines up with the previous week's high. As I've said before, when your levels line up and you get the information from different sources, it's an even more powerful level. And it's a little bit confirming, kind of gives you a nod that you're doing it the right way. All right, so you can see how quickly we've got a bunch of lines just really starting to overwhelm. And on this higher time frame chart, it's not going to get any cleaner, right? It's just going to get worse and worse as I add more levels. But once we start dropping down into the smaller time frames, all of this begins to clean up, right? So one thing that you could really consider is using different layers. When you draw something on a different layer, you can hide it, turn it off. And that way, when you are on those higher time frames, you don't see any of it. You can turn it off. And that's where it's most cluttered. Then when you get into the smaller time frames, you can turn it back on. And that's where those levels will really start to help you out. All right, we don't have an MDP because we've crossed through the pivot point. We had a really nice double bottom, which, if you're kind of new to patterns, a double bottom is a bear trap. It's designed to trap bears, be a reversal pattern, and a rally back up, which we didn't get, which means it's no longer a double bottom. It was just a potential double bottom. But we do have another potential double bottom coming up if we can get back down to that 41.86 area, which would be yesterday's low. I'm really looking forward to that one, by the way. I think that's going to be a really nice play, but we have to get through the RTH low around 41.90 first, which would also be a double bottom opportunity. Just remember, it's not a double bottom until it already is, right? It has to happen for it to be a double bottom. Until then, you want to get used to using that word potential. If you go through the analyst books and you kind of study up on technical analysis, it's a word that is in there. But at some point, we all start to take shortcuts and we quit saying potential support, potential double bottom, potential flag, because you just get tired of saying the word after a while. And so we just say, oh, it's a double bottom, it's a flag, but it's not yet. Only when you look back. It will make sense for us to expand a little bit lower. The megaphone kind of implies that that's exactly what we're going to do. Widen out a little bit at a time, getting a little sloppier each time until we finally spin out of control and break something. Just keep in mind, they can front run these pivots just as much as overshoot them, right? So if we're looking at 41.86 and we're thinking a good double bottom would shoot through that, trap the bears, convince the bears we're really going to short, and then squeeze them and pop them on the way back out. That's what we would expect, but they could just as easily front run the trade, worried that they're going to miss their entry, and price never actually gets all the way down there. never even reaches the double bottom starting point. And so there you are, waiting, trying to get a trade, hoping it's going to come down and get you, and it runs away without you. I think we've all been there. It sucks. The ADR is 1.2%. So, it's not that wide, kind of been sitting in our normal range. We were close to getting the ADR high. I don't know if I should say it that way. We made a run for it, right? We certainly got closer to the ADR high than we did to the ADR low. But now we're, doing the other side of the thing. So 42.33 ADR half, and 41.82 is the other half, which is resting right on a weekly pivot point. So if we go to the downside and we do overshoot, that's exactly what I would be aiming for, is that 41.82, because we will gravitate right to it. Especially when you think about how a double bottom is supposed to work, right? When you go back down and you get to that previous bottom, we want to go lower than the previous low. That's what makes it so good. So we want to overshoot and then come back up. The overshoot is that weekly pivot point. All right, we still have the 10-year expanding 3.74%. This is a really big deal. It's going to start getting more and more attention as the morning wears on. I would watch this one really close. We want to see if they come in and start defending it. Watch the news and watch this. You're looking for Yellen. You're looking for any of her older counterparts, anybody to come out that they can interview, for them to tap this back down. And this is something that really, it took me a long time to understand, because nobody ever really pointed it out. That plunge protection team is a real deal. It's a real thing. But it sounds like a conspiracy, right? Like get a tinfoil hat and all that. But the thing is, one, it's not just for when the markets are spiraling out of control to the downside. It can also be when they're running too hard to the upside and they just want to slow things down a little bit. But they can also go in and move things like the 10-year and things like that. When I first kind of heard this, I thought, well, how can they make any money doing that? You got to spend a ton of money to try to move this thing. Because in my mind, they were trading something, or they were entering into or getting out of something to make it move. It never occurred to me that they don't have to buy or sell anything to make this move. All they got to do is open their mouth. If they come out and start talking about something, rate cuts, for an example, whether they're going to cut it or not, they could just come out and say, oh yeah, I've really been considering a rate cut. Boom, there goes the market. Right? So when it's a coordinated effort like we had last Friday, multiple news channels showing multiple leaders, like Yellen in one spot and Powell in another spot, and there was other leaders at other spots, and they were all hitting on different things, but with the same outcome, right? Trying to push that market down. They didn't get very far, but that didn't mean they didn't try. We're getting a little out of control here with this 3.74 this morning. I really anticipate somebody's going to come out and try to defend this thing today. And that's what we want to be looking for. We see a flip in this. We also want to be watching TLT on the other side for a flip in that. I used the ETF equivalent, TLT, but ZB, ZN, ZF, any of these, right? We got bonds on one side, yields on the other, got dollar in the middle here. So that big spike up in the dollar there, we don't want that. We need this thing just to calm down, right? We want to see the dollar calm, maybe ease away from that 103.5, get back down into the 102 area. we really don't want to see this break out of last week's levels, line in the sand, right? We can wick out up there and then finally maybe pull back and, have a capitulation top or something like that. But we don't want to see solid expansion and a solid close above and a continuation farther higher in the dollar. So the dollar needs to calm down. 10-year yields need to calm down, get back below that 3.7. I'd call it 3.7 flat, right? Get out of that 3.7 completely. And then bonds turning around and finding some support, right? We need all of these things. And that's the great part about it. If it's just one piece, right? If you're just watching TNX and it turns, you've only got one piece of the puzzle. You can go to the next piece and then the next piece and until you've got all of the pieces put together. All right, we are topping out in US dollar Japan. So as we top out here and then, say we begin to fall, we see, say, the dollar begin to fall, 10-year yields begin to fall, bonds turn around and start to run back up. And then we get oil and, say, the financials, KRE, XLF, your inflation trades, gold miners, all start heading back up. For a good rally on any day, we want as much of the market to move with us as possible. A good strong rally day or a good solid bear day, either one, right? When we just have a good trend up or down. The best ones are when we're running with all of the market. These are the risk on sectors right here: XLF, XLK, XLY. So when we're in a, having a bullish day and everybody's feeling froggy and frisky, these are generally what we need. We need finance or tech, and then it's usually paired with consumer discretionary. When it's, what does Bloomberg call it? The animal spirits, whatever. It can be finance or tech, but it's much better when it's finance and tech paired together with consumer discretionary. And consumer discretionary might not sound very glamorous, but that's where Tesla's at. And have you seen what Tesla did in the last 24 hours? So we're going to get assistance from XLY. We really just need to know, are we going to continue this drive in the mega market cap tech, or are we going to continue to see this penny stock trash continue to float to the surface like we've seen started yesterday? And there's still no expectation that we get anywhere beyond an expansion a little bit lower or an expansion a little bit higher until we get some answer on this debt ceiling. I'm trying to remember the last time we were in a situation like this where it looked like we weren't going to get anything until whatever that is. And that's what I'm kind of stuck on. I can't quite remember, but we were all waiting on it for days. And the market just said, screw it, broke out and started running. And everybody's like, well, it's a fake breakout because we're all waiting on this thing. And it kept going and it kept going and it kept going. And by the time everybody was convinced, well, shoot, maybe that isn't a fake breakout, it had already made a massive run. So as much as I'm sitting here saying it's very likely that we, tag the edges, expand a little bit and come back in, what we call sell into strength and buy into weakness, that we're going to play a range trade until we get the data. That's the most likely situation. But it doesn't mean I can't be wrong. And it doesn't mean we can't get the other thing. And the other thing would be that we drop out of this box and fall hard, or we break out of the top of this box and we start running towards 4,300. Don't take it off the table just because I'm talking about the other one way more than I'm talking about that one. It's okay. I'm not afraid of being wrong. All right, so what we're looking at here, KRE on the left and NY Fang in the middle. Um, you can see how they really weren't working together yesterday, right? We had this nice move in the Fangs, and we really didn't get much out of finance. And then in the later part of the day, when we finally did get something from finance, we weren't getting any help from the Fangs. So this is that tech versus finance kind of point of view that we're talking about. In the lower portion down here, this is where we're looking at the advancing and declining issues. Now, no indicator is perfect. This isn't looking at what is moving up right this minute, and it's not looking at what's moving it down right this minute. It's looking at how many names are up on the day versus how many names are down on the day. That's what it considers an advancing or a declining market, which for one means you can't use this as reversals, because you could have things that have already ran 4% on the day start to fall, and they could fall 4% all the way back down. But as they're falling, this will still say they're up on the day. It'll still say that those markets are advancing. So these kind of indicators, these breadth indicators, like advancing minus declining issues and that kind of stuff, they're only good for a broad perspective, because advancing, generically defined as being higher than where we closed yesterday, that's its only criteria to be an advancing market and to show up on this list. Yeah, you can use UVol and DVol, and it's just like what it sounds: up volume, up tick, down tick. There's a lot of different ones out there with varying degrees of usefulness. 10-day, 30-minute volume profile, we've kind of lost that classic shape, right? We had that B shape, lowercase b, and it's slowly getting unraveled. Soon we may end up with more of a capital B if we continue to spend time above 4,200. We should grow this zone out more to where we're going to end up with more of that classic B. What we want to be watching for is, has the point of control moved, right? Because right now it's recording 6 days where we were range bound down here. That's 6 days of volume down there. We've only been at our current location. This is day number 3 now. We got there Friday, we have Monday, and now we're into Tuesday. So, if we take that point of control from down there and we move it up there in day 3, when it took 6 days to get that and 3 days to get that, would really show that we're putting out a lot more volume than the overnight cumulative volume would imply. All right. Since it's kind of a slow morning and going through the equities, might be a little bit of a hamster on a wheel, since we're all waiting for this data to come out. And the expansion's really starting to look good on the ES. It's getting close to the point where I think they're going to come in and defend that 10. If we can push just a little bit lower, maybe that 4185 area, something like that, that'd be just enough. But with everything being slow and we're waiting on this dead ceiling and we're in this tight range, I thought maybe we'd hit a little bit on pivot points, especially as a day trader. One, to kind of get you on the idea that you're not doing it wrong, and show you ways that you can validate that and begin to prove it to yourself so that you can trust the stuff that you're using. There's a lot of work that you're going to have to do to get to that point where you can trust what you're using. this hopefully will show you how to get that trust. So there's different pivot points, right? Generally, we're looking at the 5-day, 5-minute, and we're bringing over value area high, value area low, and the point of control. If the point of control hasn't been hit yet, like we had last Thursday, the point of control that we grew there after Thursday's close, we haven't come back down and touched that level. So it's a point of control that is carried forward that we have not yet returned and hit. Thus, it is a virgin point of control, a VPOC. And yeah, I'm not the person who named this stuff. So you can name it whatever you want. And those are more of a mark of liquidity, right? They're not support, they're not potential support, they're not possible support or resistance. They're just marking where the greatest amount of volume was traded by price in that day. Usually it's because we spent the most time at a particular price, but that's not always true. And we can use something like a TPO to make that determination. But this is just carried forward pivot points from the volume profile. And it's a very common thing to mark those out, carry them forward. These are voodoo lines. And unfortunately, I can't explain what they're made out of because they don't really have a lot of documentation that tells us what they're made out of. They're also one of the few indicators that I can't just share with you. Anything that is open source that I get my hands on, I give it away. And any indicator that I make, I give it away because I'm not in the indicator selling business. So if I make it, you can have it. But there's companies that sell indicators, and you can't just get one of their paid indicators and run around giving it away. This is one of those. I didn't want to get caught in a situation of giving it away and getting in trouble, right? So I just don't give it away. This is one example of a lot of pivot point indicators that you could buy. If you search over the internet, there's a ton of them. That doesn't mean that they're any good. And I've seen people sell indicators that should not be sold. They should just be given away. Like yesterday's high and low. That's for sale somewhere. And I'm sure someone's bought it. If you're using a custom indicator that you bought, it should come with documentation. So hit YouTube, search for it. That can kind of get you pointed in the right direction usually. What I've got marked right now are pivot points, floor pivots. So it's got your PP, your pivot point, and then like a S1 support one, R1 support, resistance one. I've got it for the day, the week, and the month, and it's all loaded right on the same screen. Looks like that. You just take SVE pivots and load it again, take the same indicator and load it again, and then just change it from day to week to month. One thing that's tricky about Thinkorswim, you have to have enough days showing for the indicator to work. So if you put it on a monthly and you've only got 3 days of data, there's not enough data there for it to calculate a monthly pivot. It won't show you the line at all. Same thing with a weekly, right? If you try to show a weekly pivot and you have 24 hours of data showing, you're not going to get a weekly pivot. So it doesn't matter that you can sit, like right now, I can only see 7 days of market data, but my chart says I'm looking at 25 days of data. And that means I can see these pivot points. All right, so these pivots are a mathematical formula. And again, not support, not resistance. They can't be support and resistance. Price doesn't know where they're at, right? They're literally just a math formula. It's derived by taking open, not even open in this case, taking high-low close of the previous day and dividing it by 3. That's how this line is designed. 41.81. That's a weekly pivot. And it took last week's high-low close, which are 3 different data points, divided it by 3, and that's where that line came from. So it's not support. It's not resistance. It's just a math formula. And yet when we're above it, we're bullish. When we're below it, we're bearish. So it provides context and bias on the market, right? Are we at least above our average, right? That's kind of what the question is. Here we've got hand-drawn pivots. My monthly levels, weekly levels, quarterly levels, daily levels. And you can keep on going with that and take it down into hourly, half hour, whatever you want. I keep them shaded for the most part. Some that I want highlighted more than others, I make darker. I take full advantage of the ability to label things so I can just tell at a glance what it is that we're about to hit. And as you can imagine, if I was sitting on a daily chart, that would look really cluttered, really nasty. Not getting a lot of help there. And they go back a long ways. But none of these are the dailies, because that would really be a mess. My decision to keep them highlighted bright and solid, or to shade them and make them harder to see, is based on how many examples of a pivot they're overlapping. So if I come out on a weekly chart and I've got a line drawn and it has a high, a close, another high, an open, and I'm getting 4, 5, 6, 7 different pivot points all lining up on that one spot, I'm going to make that a darker pivot than the rest. So that it'll stand out and get my attention more. When it comes to this hand-drawn stuff, this is a really great spot to also add in things like a gap. But for the ES futures, really the daily chart gap that you will see is showing you the wrong gap. It's showing you the gap between 4 and 6. That's not the gap that you really want to focus on. It is a gap to keep track of. I'm not discounting it. But the real gap that you want is the gap between 4 o'clock yesterday and 9:30 this morning. And you don't see that gap on the futures, not on the daily chart, right? If I go to the SPX, yeah, sure. So for the futures, the easiest way to mark that data is to turn the Globex data off and then go in by hand and mark your levels. And with these pivots, really keep in mind, we want to use them to define the narrative, not necessarily to try to take a trade. So we were coming down into this monthly level. It's not like I would be sitting there like, oh, I'm going to get me a trade. We got to come down here and I'm going to bounce off that. It's more of the idea of, okay, I've got a level in sight. We're headed down to it. What if that was last month's high, for an example? And now we've been broke out. We had an inside month breakout, and we're coming back down and we're testing the top of last month's high. Now it's a part of the narrative. It's not just a line that's a pivot point that we might trade off of. It's also, oh yeah, and we got weak enough that we broke back inside last month's high. Then consider the way price looks. Did it move away from that zone really fast? Does it imply that there are trades that didn't get completed, or that traders got trapped, that they bought at the tippity top and it dumped down on them? Because the next time we come back up there and we let those trapped traders out, oh, they're getting out, right? They will jump on the opportunity to avoid that losing trade and puke that position up. Doesn't mean we couldn't break through there, but it does mean we would anticipate some selling the next time we got up there, and that it might take multiple attempts before we finally broke through and made it, because there's going to be a lot of trapped traders, right? So these pivot points that you're marking out, consider what the pivot looks like, what it's marking. Try to carry more in your thought than just, yeah, I'm marking yesterday's high and I'm marking yesterday's low and last week's high. Why are you marking it? What does it look like? What's the anticipation when we get back to that level again? These are the spot gamma levels. I don't have something for tier 1 alpha because tier 1 alpha just sends an email. We got to take those levels and put them on the chart. I had considered building an indicator, and then we could just type the numbers into the indicator and it would plot it out on the chart. I might still end up doing that, but for right now, I've been just looking at the levels from the email and verifying that they match, or that there's nothing more from that compared to spot gamma. If there is, then I'll mark a line out or two. Another thing, in that email and even with spot gamma, it will give you levels of like 4,400, 3,900. If you're kind of in a hurry or you got a bunch of lines everywhere, it's not like we're going to go to 4,400 today. You don't have to sit there spending your morning trying to mark out levels 200 points away, missing out on opportunities that are right in front of you. That might sound a little Captain Obvious, but I don't take it for granted. We can get caught up in what we're doing and not even thinking about where we're doing it. And these are cog lines, although they're on this 5-minute, they're really not doing us any justice. There we go. Now I've been keeping all of these separate. That's why every chart we went to only had one set of pivots to it. The weekly floor pivots or floor pivots, cog lines, voodoo lines, volume profile lines, spot gamma lines. If, as you can imagine, if we lumped all of them into one single chart, there would be lines all over the place. We wouldn't get anything else, right? We would just be too cluttered. So, consider spreading them out so that they're not all on one location. They're not all on one chart. Turn some on, turn some off. Make multiples like what I've got going on here. You notice how I'm just jumping from screen to screen. I don't have a bunch of floating charts all over the place. That'll really bog down your computer. I'm just using the arrows up here and I'm skipping over to the next one and the next one and the next one. I've got a video on this. I've done a whole series of videos on how to set your Thinkorswim up to look like mine. Not because I think mine is the perfect setup and you should use it, but because if I'm going to teach you how to use Thinkorswim, I needed to teach you how to use it on something. So I just built mine. Watch the videos. You'll know how to use Thinkorswim and change these things, whether you make it look like mine or not. There's no perfect set of pivots. There's no better ones, right ones, wrong ones. There's just understanding what the pivot is and seeing if it's something that you're already using in a different way, or if it's going to offer you something different that you're not yet using. All right, now here I've got open, high, low, close. That's all that I've got marked. But you can do that for the day, the week, and the month, rather than hand drawing last month's high, last month's low, last month's close. I guess I misspoke. I don't have the open. I have the high and low. Now we've got the high, low, and open. So even those, you don't have to go in and mark on the chart the high, low, close on the weekly, the monthly, the quarterly. You can do it with the indicator. And for using these things, there's a million different ways to use a pivot. There's a lot of strategy that I picked up on pivot trading. I don't necessarily trade it the way that the strategy is taught, but I learned a lot from the strategy that was out there. So for an example, person's pivots. So person is a real person, and his last name is Person. He made a bunch of indicators, and thus you get something called person's pivots. Well, he wrote some books, did some webinars, built strategies that use person's pivots. And his indicator isn't really too far different from a floor pivot. And in the material that he developed, he talked about how he would trade as price came up into one of those levels. That's just one. And Thinkorswim, these aren't all the pivots out there, right? They all just don't have the word pivot in it. So these Camarilla points, these are also pivot points. It's just a different one. And each of these have a different strategy, either by the person who created the indicator or by someone who's been using the indicator and built their own strategy. But every one of those strategies are a pivot point strategy. It's the idea that somebody built a system, whether it's a trade or analysis or something, that deals with price as it comes into a level that we've identified before price got there, like 41.90. I can see we're heading in that direction. I can have a trade ready to go for when we get to that spot, rather than trying to trade it to that spot. I could be waiting down there to get a trade using any number of strategies, from person's pivots to SVE, Camarilla. Oh my goodness. You hit Google, you'll find a ton of them. There's more of them on Thinkorswim than you would imagine. So hopefully that'll give you something to target, right? And again, I don't, just because I know a strategy doesn't mean I trade it. And I'm not recommending that any of those strategies are good or bad or whatever. But if you read the book or the webinar of one of these, it really will change your perspective on how you see price, and maybe how you understand the way price interacts with those pivot points. It really is about liquidity, right? And the understanding of who's in there, how the pivot got developed, and then what our expectation is going to be if price manages to get back down to that same spot again. Look here where they front run yesterday's RTH low. So we didn't make it back down to the low. They piled in early and stopped price from getting down there, likely because they didn't want to miss the turn. But that doesn't mean that we still can't go down there anyways. So it's just different lingo, right? It's different points of view. And now that we've made our expansion that we talked about earlier today, we really don't have much left on the table except to hold the low, maybe wick a little bit lower, and then come back up again. All right, we got the China ADRs falling out this morning, down more than 1.5%. The Hang Seng Index, China, down more than 1.25%. Emerging markets, which is not a surprise, right, would be right behind that. And then gold. Remember that what I talked about with gold, we're looking for a bond flip with the ES and the NASDAQ to go with it. So we want to see US dollar Japan begin to fall out. We want bonds to start ripping to the upside, and S&P and NASDAQ to go with it. So we'll have stocks and bonds both moving to the upside. This should be a rising tide lifts all boats kind of swell, right? You want to be able to go in and see market breadth sitting in the 97th percentile, something like that, something really high. Right now, we're more flat in here, looking at all these different ones. They're at zeros or slightly down, slightly up. We don't have extremes on the plus side or the minus side yet, really. TNX at 1%. That's your 10-year. So that's the one we want to see flip around, start heading to the downside with the Dixie. Financials are kind of flat. Certainly not up enough to hit my benchmark. And Bitcoin too, flat or not up enough. So here with the 10-year, we want to see this thing really calm down. We do not want a repeat of this thing getting out of control. So put out here on the daily, we got the bottom of this channel, 3.8. That's too high. Hold on, we definitely just don't want to get there. 37.53. We got to get back down below that line. Got to keep it below that line. So when they talk about a line in the sand, that's the line in the sand. For the TLT, I'm going to use a phrase that's not mine, but it's really easy to understand, and you'll understand why it's such a great phrase. They need to defend this, or else they need to come in today and start actively getting this thing moved in the other direction, or else. So $100 psychological level has some merit to it, some weight. We do have a little time left, right, between where we're at currently and that $100 level. And then you can also see that we've been lower than that. Even this year, back in February, we got lower than that. And on that day, by the way, I was saying the same thing. They're going to have to come in here and defend this or else. And it was a really nice rally out on the ES that day. What a ripper we had. So we try to link these two charts up. Got the ES on the right and TLT on the left. And it was this day right there. So from the low of 39.25 to the high of 39.95, a 70-point run that day, and then the follow-through day just as good, right? Another ripper. In fact, the next day was much better. But it started with that morning when we gapped down significantly. And really consider, right, the way we want to kind of walk it through. We closed there and we opened way down there and then rallied back up. And the next day, really great follow through. I'm a day early. We're not below 100, but we're heading towards 100 and things are getting a little out of control. The swag or the inverse with the 10-year is why I'm saying it today instead of waiting. The 10-year at 375 is not where we were at last time when this TLT got below 100 and made it down to 99. So we've got a 10-year a little more out of control this time than last time, which is why I'm saying it here above 100 instead of down here closer to that 99. Watch the 10-year today, guys. The TNX, TLT, DXY. The VIX really isn't going to help you much. Not today. It's already up a lot too. So anything the VIX could offer is already blurred. Got SVXY. You could try to use something like that, especially on the intraday. That'll help out a little more. So here's the ES on Friday when we had that pretty sharp sell off around 11 o'clock. And here's SVSY where it had topped out Friday and it really rolled over to the downside hard, giving us that heads up, right? Had more conviction in that short, watching SVXY waterfall to the downside. All right, Apple really didn't recover much yesterday and now back down again this morning. To get an inside day breakout, it's a long ways off. So while it's possible, it's doable, we really need that inside day breakout for it to have any value, right? We got to get outside of this big candle from 518 because this wick structure from yesterday, from Monday, isn't showing, but it lines up really well with Thursday's low. Yesterday's wick that we're looking at here matches Thursday's low. So just use that. That's 172.58. Until we get below that, we don't really have a good short. And even now, I mean, this is just a healthy pause after such an enormous run, right? So it's not like we're looking at short Apple all the way back down. And then I think the play is more of a long play than a short play. So long off support at 172.5. If we break 172.5, then long off support at 170.76. Meta did good, even though they took that fine, right? That 1 billion plus fine from the EU. Apparently, it's not the first time they've had this situation or even something similar to it. And investors didn't care, I guess. I like it short back to 240, honestly, but I'd say wait to get inside of this box first. That would just be Monday's price. You could use Friday, but we're already inside of that. Think of it this way. If we break our own Globex low at 247, I think that'd be a nice short back to 240. Just maybe kind of approach this with caution, right? Because that was one heck of a gap, and everybody was waiting for this to have an island reversal, break 230 and come back down to that 210. And instead, we're continuing the move to the upside, right? So this is not an island reversal anymore. It was just an island, and now we're continuing on. It's still crazy bullish with a lot of money in it. All right, looking at Google on the weekly, we got through a major level at that 122. And as long as we're holding above it, we want to continue to just look for long opportunities. But we're still inside weak. I had someone asking about, their chance to get into Google. Was it too late? No, I don't think it's too late, but you still got to get it in, right? So if you can catch a bounce on 122, that'd be an in. But at this point, that would require that we go back down, and we've already had our pullback to 122. So it wouldn't be as healthy. And so you wouldn't probably want it if it came back to 122 at this point. Instead, you're now going to want the breakout above 126. It's 125.97. It's last week's high. We've wicked out. That ain't enough. Got to keep going. The fact that we didn't crash and burn, we wicked out of it, came back in and held it really well, implies that, it still could. So you're not too late. You just needed an opportunity to get in. And the gap fill, $133.30. $131.82 is the start of the gap filled channel. Long ways to go before we get there. I would also be cautious of this wick. If you think about what that day looked like when it opened and it rallied and there were buyers, that there were buyers right up there. And we haven't come back to this level. So all of those trapped buyers are still looking for a chance to get out. And if they get that chance, they're going to take it. So the first time we get there, we're very likely going to pull back at least once. And you can be bullish and sell calls, right? So if I was looking at this and wanting to sell calls, the 130 calls for a short duration on the idea that we're going to have to fight to get through that level, that'd be a good way to go. I would feel pretty confident about that, but I wouldn't do it for a long-term swing, right? Because the drive of this, the analogy is if you keep kicking the door, at some point it's going to open up. Persistence beats resistance. Microsoft is dealing with the exact same thing right now, just at a different spot. That entire area is a big wick situation. You can see even as we started to get close, people were selling out of it. And then we started working through all of that liquidity that's in there. Now, once we get through it and we're on the other side, we can consider that liquidity gone, right? That we've absorbed it all, that it's just off the table, it's resolved. But then there's still another level way up here. I don't normally kind of go through all this, right? But with the hurry up and wait situation, I thought, well, it'd at least give us something to focus on and work through a little bit. The equities are very likely going to continue to do better than the indexes until we get a resolution of this debt ceiling, whether it's kicking the can down the road for 6 weeks or they actually resolve the darn thing. So, hey, I love trading SPY and the Qs and that's my jam, right? And trading in the futures, but there's some really great markets running right now to where, if you're looking at the ES and it's a sideways day with a bunch of trash and we're just not doing anything that you like, log out of your futures account and go over to something else and trade something that is doing what you like. Watch the clock, guys. Be careful, be safe. Bonds, dollar, yields, US dollar, Japan. They're going to be your tells. I'll see y'all.